All right, well, this is a topic that I get excited about and spend a lot of my time on these days. So I've been really looking forward to this panel. I couldn't thank enough the panelists for joining in this discussion. You know, we talked about data centers as a new asset class, but I think we also need to think about, and we definitely need to open by talking about how, as investors, you're also thinking about credit and how you allocate credit to customers. How do you look at the credit profile of your customers and their customers, and how does that affect your decision making? And you know, if I wouldn't mind picking on Jim to start off with that, because I know that that's something that comes up a lot in your IR and in your investor calls. So tell us how you think about the credit story as you're growing your business.
Yeah, thanks, Zach. It is a very significant change in how we look at our history in the Bitcoin mining side of the business in this conversion that we're making into a more traditional data center model, and the financing structures that facilitate that expansion typically go right to the credit quality of the end customer that's serving the infrastructure for what is an extended period of time. So your ability to effectively price and structure the opportunity is a direct correlation to the quality that you're underwriting in effect for the duration of that contract period. And so being able to take advantage of the more stable customer at the end of that contract period is going to facilitate more attractive terms that ultimately you're going to get from the lending community. At the end of the day, you need to make sure that the rent that you can charge in order to cover that is commensurate with the risk that you're taking on the other side. So what you're seeing is a very dramatic shift in how we've operated our business in the past. Both are capital-intensive businesses in a very meaningful way, but they both come at that financing angle in very different structures.
Paul, if we wouldn't mind also getting your opinion on how you look at credit, how you look at your customers' credit, how you think about pricing, which are the customers that you're going for, which are the ones that you're deciding to stay away from in this environment.
I would echo the risk-reward element is key. For us, we decided early on that our model would be to focus on the colocation model. And the theory was, you could work with a hyperscaler and get 9 points, or you could work in the colo and not have quite the same credit opportunity, but price to 15 or 16% return. In our case, in TeraWulf's case, we ended up with world-class credit, Core 42, guaranteed by G42. There were a lot in the news last week with President Trump's visit. As our ultimate off-taker. And so our business model was predicated on, we put our equity in, we built the data center, we locked up a customer, super high quality credit, it's effectively a sovereign credit. We've launched our project financing effort. We think we'll end up between 400 and 500 over, and then we'll take our cash back out, put it into the next phase, and wash, rinse, and repeat. Credit quality is everything. For us, because you need to be able to project finance. So I think there are other co-location credits that aren't Core 42, but ultimately you'll be financing to whoever the end user is in that case.
Patrick, if you wouldn't mind also sharing some of the challenges and deals that asset owners have had to or might have to, or won't ask you anybody specific, but if there are deals that you've had to walk away from because the credit just didn't pass the test.
I would say unfortunately not. I mean, we come from a little bit of a different perspective. So OPCORE is a traditional sort of colocation provider. We've been around for like 20 years. Half owned by the Iliad Group in France and other 50% from private equity in Prager. I would say so far the demand has been such that we offer both cloud services and obviously colocation for AI training and inference. So far, the demand has been taken by traditional cloud providers for data centers in France. Nevertheless, we can see coming, there's definitely a trend towards the bigger AI workloads coming from the neoclouds, simply because they are so agile and so expert at managing them. So we anticipate having to deal with that situation, if you want. But I think the gap is not necessarily that insurmountable. Typically we would ask for a 7-year lease, maybe a cash-on-hand security deposit, parent company underwriting. So I think it's doable. It's still, at least in Europe, I would say, the big deals around AI are now led by, I think, solid players, I would say.
Ben, do you mind sharing some strategies in terms of how you look at credit enhancement, or how do you improve the package with the client? What are the different levers at the disposal of an asset owner in negotiating when you're trying to match credit to risk?
I think the first part of this question is the fact that we're even talking here about credit really shows a very big transformation in the space. To think that 12 months ago, 3 Bitcoin miners would be here talking about how we can be picky and choosy on which credit partners we're working on and which terms we're negotiating is kind of mind-blowing, right? The fact that we're now here in this stage where the Bitcoin miners have now been put into a position of bargaining strength, as opposed to being on the receiving end of whatever opportunities that we can get, I think really highlights the opportunity here for the space. And what Bitcoin miners, I think, are trying to solve for when it comes to getting a deal here is how do you unlock the most amount of value for shareholders? And the traditional Bitcoin mining industry generally is going to be looking at trading at like a 3 to 5 times multiple. When you look at data center companies, it's usually like a 20 to 30 times multiple. And so, we're trying to unlock value for investors with that certainty and with those long-term contracted revenues. And so there's going to be a balancing act there that we have to play between trying to get the most amount of revenue and the healthiest amount of margins, having the better maybe counterparty for lower costs of capital, and then also making sure that the contracted revenues that we are securing for a long period of time are not being discounted because of that counterparty leverage. I think the real opportunity here is that most of these Bitcoin miners have been investing in scale for the last several years. And you look at the traditional data center business, and they've been investing in location. So it's huge portfolios of really, really small data centers. 1 megawatts, 3 megawatts, maybe Carnival Wharf or Bay Street or Wall Street, something like that. But the Bitcoin miners have invested in scale. And when it comes to the computing needs of today and 5 years from now, it's not based on having 1 megawatt in the middle of Manhattan. It's based on having hundreds of megawatts or gigawatts of scale and these kind of campuses that can really support the AI workloads of the future. So the biggest lever that we have as a company is that we have the assets that everyone ignored for several years, which is these large-scale data center campuses. And that's really what gives you, I think, the biggest opportunity here when you're negotiating with customers, is because we have what everyone wants, and it's huge amounts of power right now and leading off into the future.
And that's a perfect segue into my next question. It's not, I think there's more to it than that, right? There's more to it about why the 4 people on this stage are stealing market share. Not everyone on the stage is a Bitcoin miner, but you guys are taking market share from the establishment, right? The established data center players. Some of you have even had a history working at those organizations. So if I could also use this question as an opportunity for you to introduce yourself and your business to the audience and say what it is that has helped you and is helping you have an advantage over the traditional players to be able to capture and grow market share in the space. Paul, if you wouldn't mind starting.
Sure. Well, the very roots of TeraWulf we're an energy infrastructure team. We've been in the power business for almost 30 years. And actually, the management team's been together for over 15 years. So we have owned, operated, developed, financed, restructured over 5 gigs of power, and that's pretty remarkable. So the space today is about energy infrastructure, and I don't think every Bitcoin miner can be a HPC AI compute guy. I think, sites aren't all created equal, and you could have a great site, but maybe the grid's not that robust or the grid operator's not that sophisticated. I think when you hear some folks talk about 1 and 2 gig sites, I think that's kind of silly, because to manage 5 nines of electricity at the end of a single transmission line in West Texas, I don't think that's easy. We haven't figured out how to do that yet. I think TeraWulf's advantage is that we have owned energy infrastructure, we understand it, and our initial site, which is Lake Mariner, we have 1,800 acres, 750 megawatts, utility-grade energy infrastructure in the ground, and a 20-year working relationship with the grid operator. So I think that, and by the way, we have some Bitcoin mining at site. So as you continue to build out the next 500 megawatts of HPC AI load, we can buffer that load for the grid operator with our 250 megawatts of Bitcoin mining. Ultimately, I think all 750 megawatts becomes, HPC and AI. And the reason for that evolution, as Ben pointed out, you can go from 3 times to, if you're a REIT, 18, 20 times. But also, in our case, it's a return to the roots of our business, which was long-term fuel supply. In this case, we'll call that electricity. Long-term offtake agreement with the utility. In this case, it's with Core 42 backed by G42. Very predictable revenue stream, and you operate in the most efficacious manner on the planet. And so that's sort of why we were selected by Core 42, and that's why we want to continue to grow with partners like Core 42.
Patrick, if you wouldn't mind also sharing a little bit about OPCORE and OPCORE's background, how OPCORE looks at the space differently. You were previously at Digital Realty. How does OPCORE look at things differently from traditional players like Digital Realty, and how does that give you an advantage over these behemoth players?
Yeah, thank you. So I think the main difference, if you look at the big guys, the Digital Realty, the Equinixes, they're very much focused on offering a global set of portfolio of data centers to address the tier 1 enterprises who need to distribute some compute, some storage all over the globe. So traditionally, they build the data centers in metro areas. It might be used for high-frequency trading at best. At worst, it's just some storage that needs to be localized and a bit of compute. And they actually have to roll out a design. And so innovation takes a long time to sort of filter to all these locations. OPCORE, on the other hand, we purely based out of France. And what really attracted to me is that they really saw the need to do things a lot more like these guys are doing, basically, which is to tailor your data center to the workload rather than the opposite. And to take scale into consideration as well, especially when you talk about AI. So the engineering team, everything is done in-house, 100% in-house in terms of engineering, design, operation, etc. And they spend an awful lot of time coming up with a modular approach, which allows you effectively megawatt per megawatt to tailor whatever cooling and power redundancy that you need. And in such a way that the cost of build is probably 3 or 4 times less than what the big guys have. So obviously it allows you to hit the right price point for the hyperscalers and the neoclouds, and it also allows you to scale. But I think it's a complete different mindset, and we have really 2 worlds now which are maybe at some point converging, but I think we'll still have massive hyperscale where the intelligence is created, and then it will have to be used maybe in metropolitan areas and maybe elsewhere. But it's quite fascinating at the moment.
Continuing on that thread, Ben, if you wouldn't mind sharing for the audience, I don't know if everyone in the room is familiar with the kind of hardware that we're talking about and the needs of that hardware, why it's different from traditional data centers. If you wouldn't mind giving us a crash course on what's happening on the hardware side, what's driving these needs, and then share with us a bit about how Bitfarms takes a similar approach to some of your colleagues on the stage, or any differences in approach to addressing those needs for your customers and doing it in delivery timeframes that they're asking for.
Yeah, I think it's a great question. I think there's a lot of lessons to be learned from Bitcoin mining because of the economic incentive around Bitcoin mining. It really is kind of at the cutting edge of new chip designs and new architecture, because you don't have to build out a line of customers, you don't have to build out marketing, you don't have to build all these support services. There's a direct economic incentive with making a brand new efficient chip and monetizing that. And what that's led to over the last couple of years is every single generation gets incredibly more energy dense, which means that there's a lot more heat being generated in a much smaller amount of area that needs to be dealt with. And so there's a convergence here that's taking place both with Bitcoin mining technology and with HPC technology, where the demands for the computer are getting so much more compressed, and you have to fit so much more energy and compute and cooling into a small little square foot area, that the reality is that there's not a data center that exists today that is built for the needs of tomorrow. The needs for tomorrow have to be started to build today. And so you look at kind of where the energy density has gone. We've gone from 10 to 15 kilowatts per rack to 100 to 200 kilowatts per rack, and it's going up increasingly to the point where NVIDIA is forecasting it could hit upwards of 800 kilowatts per rack in the next couple of years. There is no data center, like I said, that can meet those demands, and so there is an opportunity here for disruption, because there is not going to be a direct path to converting over a traditional data center that was built around 15 kW per rack and 1 to 2 megawatts per location. That all has to be built bespoke. So what we're trying to solve for is, look, there's a 2-year lead time in building one of these data centers. How do we actually make sure that by the time that the data center that we're starting to build now isn't obsolete in 2 years? And that means that we do have to be modular in design. And this is one of those areas where I think Bitcoin miners have an advantage, because we tend to be a lot more scrappy. We tend to think outside the box. We tend to be more willing to try new technologies, new solutions. We know how to eliminate unnecessary costs in the build. And these are areas that I think are going to be increasingly more relevant as we move forward. So, one of the things that we, need to understand is, like, we're trying to avoid having, sunk capital in infrastructure which is not going to be necessary. But how do you build for, a 4 times greater energy density than what you need right now? And I think the answer is, well, you build, modularly with that in mind, so that you can add incrementally the extra things that you need. And that doesn't necessarily mean that you're spending a lot more today. It means that maybe you spend marginally more to space out the equipment a little bit more, so that you make sure that you have the available space for additional liquid piping for all of the energy cooling later on. Maybe you're building out bigger cable trays, something simple as bigger cable trays, so that you can bring in more energy in the future. And it's these sorts of areas where we're really trying to focus our efforts to make sure that by the time our data center is constructed, it's not obsolete, but it's cutting edge.
Jim, Core Scientific has delivered some of the largest capacity for this sector to date. Tell us a little bit about the journey, how you've gotten to where you are, where you are today in terms of, if you're able to share the amount of infrastructure, the amount of load that you have operational in the pipeline, and what have been some of the challenges in getting there, kind of picking up on some of the points that were covered by the other panelists so far.
I very much agree with a lot of the observations around the panel here. We're experiencing the same dynamic. So Core Scientific has its roots in hosting on the Bitcoin mining front, and we quickly migrated into self-mining, went through an IPO effectively of the company a few years ago, and then had to go through a restructuring. And upon emergence of restructuring, it really put the company in a unique position to help make this conversion. We were early in making this call, but we saw the long-term value that was inherent in the colocation model, and we took advantage of it by signing an agreement with CoreWeave, who many of you are very familiar with, will represent about half of CoreWeave's infrastructure by the time we complete the contract that we're under today. We are going to be turning machines on here at the end of the month. We've got a small operation for them in our Austin facility, but the real big project in Denton that we've been pretty public about at this point is now coming online. We'll deliver about 250 megawatts by year end, and the total contract's for 590. So we are very much in the middle of this exercise, and it's been a very much a learning journey for us. I think I could echo Ben's comments. We come from a scrappy industry. We problem solve. We're able to move quickly, and I think relative to the incumbents in the industry, it's not that they can't do that, it's that we haven't seen the deployment of this kind of capacity historically. And we're well served to do that just because of our operating history and, candidly, the footprint that we have. The legacy data centers themselves have a number of customers in them. It's much harder to make that transition in the data halls because you have to take some of that capacity down. Miners are ideally situated for that because our mining is essentially a tool that can fill in the gaps as we make this conversion. So we have utility partner commitments. We have to pay our power bills. We have long-term PPAs behind these agreements. And as we make that conversion, we're able to do that more efficiently than the larger players in the industry.
And I'm going to go back to you and then work backwards, because on our call, you brought up some predictions around shifts in customer demand.
Yeah.
So how do you see customer demand evolving? Where was it in the last 12 months? Where you see it in evolving today and into the future? Would love to unpackage how things are changing from the demand side.
Yeah, and as you can appreciate, we've been busy with our important strategic customer in CoreWeave. At the same time, I think what dominated headlines in the last year was very much the hyperscaler activity. You'd read an article about general demand patterns, and then you'd read another article that says Microsoft is pulling out. But the reality is, those make for great headlines, but the reality is that there's someone there to take that demand very quickly. So the first thing I'll say is that we're very short right now on infrastructure. I think you've heard that thematic on this panel. I don't see that changing anytime soon. What we're seeing in terms of customer emergence is a more strategic effort on behalf of the enterprise. Historically, enterprise has been a challenging customer to wrangle. They are very diverse in their characteristics and what their needs are. And oftentimes they'll have, call it low single-digit megawatt levels of demand. And it's really hard to plan for a larger project when you're trying to string together a group of those. So in our business, what you really need to be successful is an anchor tenant that will effectively underwrite the initial construction of a site. And then ideally what you would do is sprinkle in on top of that smaller players that will often come with enhanced economics, because the anchor tenant of that site is likely going to get a better deal, but they are ultimately the credit that underwrites the facility. So what we've seen more than anything, I think, in even the last few months is, I would say, a more deliberate and intentional effort on behalf of the enterprise to get their needs certainly estimated, quantified, and in some cases much larger than what we've seen historically. Now, enterprise typically takes longer to make decisions, and if you're going to the large end of that spectrum, we're seeing demand patterns out of that group approaching 25, 50, 70 megawatt opportunities. That's a big change because that type of demand can anchor a facility, and it's a game changer in terms of how we deploy our capital, because that's a chicken and egg exercise for us.
So switching from demand to the supply side, What are the biggest constraints now, and what do you see as the biggest constraints in the future in terms of your supply chain? Paul, if you wouldn't mind getting us started.
I think energy infrastructure, I mean, in the United States, we're just short. The estimates range anywhere from 20 to 40 gig, and that's a lot. And even in a less regulated country, which is President Trump's administration's goal, it takes 4 to 5 years to put up gas-fired plants. Nukes are 10 years out. And you also need to invest in the grid itself. So, I think that sites that are advantageous will be the sites that govern the day. I think Jim made this point, it's not that the hyperscalers have withdrawn, the CapEx is the same. What they did, like any other bully, is they went out and grabbed every possible site they could. They then did a lot of homework and diligence, and now they've decided these sites are ideal and these sites are less than ideal, and they're making their moves. I think you have to have energy infrastructure in place. And that means everything. That's whether or not you're putting generators on site to provide redundant energy, or you've got your transformers on order and they're 18 months away. I think you have to have the energy infrastructure in place. And then you have to have long-term relationships. The beauty for us in Lake Mariner is that the contractors on site have been working for me for 20 years. I mean, literally 20 years. And so you go and develop a new site, you see a lot of land, but have there been contractors working on that site? Have they gone that far west yet? And so you want, because we're building, by the way, Ferraris. We're not building Cadillacs here. These are new science, new generation technology. And so you want to have a real level of trust with your procurement team, with your contractors on site, and ultimately your employees on site. So again, I think those with energy infrastructure, existing contractor relationships will have a big edge.
Patrick, picking up on the procurement side, how do you see the way you procure infrastructure for this business different from your history in the traditional with the traditional DC? Where are the focus areas? What are the differences with what you're looking for from vendors?
First and foremost, our biggest challenge is also around the availability of power. So, in France, obviously, we've got nuclear, so that does help, and the grid is very solid. It's just the bureaucracy that's attached to actually getting connected, so we're still looking at 2 to 4 years. Other than this, I think one of the things that we were very wary of is everything which is attached to the liquid cooling, so direct liquid cooling of the actual servers. And you have these, cooling distribution units, which frankly are going to run out. There's going to be a shortage of supply of these. So I think it's more there's the heavy stuff, obviously, on the power, but I think it's all the subsidiary, the annexes to the liquid cooling that is making us nervous. And we see some signs that actually the hyperscalers are telling us, well, this should be part of the data center. You go and sort it out. And so, it's changing in that respect, and we're having to adjust our relationship with certain vendors in order to, build up stock. But first and foremost, I think, is availability of power for us.
A question that I'll open up to the floor. We'll start with Ben, but then anyone else who'd like to make an addition, as we are running out of time. We have investors in the audience. We have bankers. We have funds, capital providers. What is left to be desired from capital allocators? How do you think that investors could better support this industry with financing structures that are more attuned to your needs?
I think when it comes to the investment side, I think the opportunity, maybe pivot the question a little bit. I think the opportunity for investors here is, where are you getting your exposure to this quickly growing market? NVIDIA has been the best performing stock of the last, I think, 10 plus years. it's outperformed Bitcoin, which is the best asset class of the last 10 years. And I think for investors who are looking to get in on this space now, they're trying to say, where am I supposed to get this exposure, right? Because what if NVIDIA is towards a peak? It's had such a run for the last decade. Where am I going to look for my discounted exposure now? And I think, what we've seen from Core Scientific, I think what we're seeing from kind of the Bitcoin miners like Bitfarms and TeraWulf who are doing this pivot is that, there are kind of secondary effects here that comes from this HPC drive when it comes to the infrastructure. And it's, I think, taking the derivative of the compute itself, which is the infrastructure asset, which is going to be the really interesting play for investors, because that's the area where it hasn't got as much attention over the last 10 years like NVIDIA does. There's not a whole lot of conferences where people go up and, hoorah, I've got a bunch of megawatts. But, Jensen Huang goes up there and he says, look at my new, fancy computer. It's 10 times faster than the last fancy computer. And that drives a lot of investor interest. But the reality is that, with the exception of the silicon shortage in 2021, compute has never been the bottleneck to growth. It has always been energy infrastructure. And so, for investors who are really looking at what is that next opportunity in this space, I think it comes from the data center infrastructure companies, and I think even more so it's coming from these Bitcoin mining companies who are transitioning from a business with an incredibly low multiple to a business that has a significantly higher multiple than we could ever achieve in Bitcoin. I could triple my Bitcoin mining business, and I'm never going to get more than a 3 to 5x multiple. But if I can transition that same megawatt of infrastructure off into HPC, I can now get a 10, a 15, 20, maybe even a higher multiple than that. And I think that's the real opportunity here for investors.
Paul, Jim, just quickly, is there anything on the credit side that you think is missing?
Yeah, I actually think the leverage finance markets are very sophisticated. They've been in the space a long time. They're the old, power generation financiers. I think they get it. I think from the investor perspective, I think they need, on the retail side, that zealous and enthusiastic sort of notion of investing that they took to Bitcoin mining needs to be coupled with a discipline that reflects, just because a guy says he's got a 1 gig site doesn't mean it's appropriate for HPC AI. And I guess I'd want to close it and say, hoo-wah, I got a lot of megawatts.
Well, you can buy 3 of these guys' stocks on your favorite trading app or from your local broker. So I don't think we have their tickers on the screen, but I'm sure you can find them. So happy hunting. Thank you guys very much for joining this panel. It's a pleasure to discuss one of my favorite topics, and I hope everyone enjoyed it in the audience. Thank you.
Exactly.
Exactly.